Ladies and gentlemen, Asian guy here, stop what you're doing, put down your coffee, turn off the news, because what I'm about to show you isn't being reported anywhere. It's being buried, it's being ignored, and it's happening right now while you're distracted by the holiday shopping and year-end market noise. Beijing just pulled the nuclear trigger on the US bond market. Not with bombs, not with sanctions, with something much more devastating. They stopped buying, they started selling. And Wall Street is bleeding in ways that the financial media doesn't want you to understand. I need you to look at a number that appeared on my screen 30 minutes ago. China's Treasury holdings dropped by $53.3 billion in the last reporting period. But that's not the real story. The real story is what happened in the dark, off the books. In the shadow banking system that connects Beijing to New York through a web of derivatives, swaps, and repo agreements that most people don't even know exists. We just received intelligence from sources inside the Federal Reserve's primary dealer network. The Chinese aren't just reducing their treasury positions slowly and quietly like they have for the past 2 years. They're dumping. They're liquidating. They're conducting what can only be described as a financial surgical strike against the US debt market. Here's what they don't want you to know. For the past 15 years, China hasn't just been buying treasuries directly. They've been using Belgian custodial accounts, UK intermediaries, and Caribbean shell entities to hide the true scale of their holdings. The official number, the one that gets reported, shows China holding around $780 billion in US debt. But the real number, the shadow number that includes all the off-balance sheet positioning, is closer to $2.3 trillion. And they're liquidating all of it, not over months, not over years, right now, in the space of weeks. The trigger was Venezuela. You remember Venezuela, right? The oil embargo that nobody talks about anymore because it got buried under other headlines. But Beijing was watching. Beijing was calculating. They realized that if the US Navy can just board tankers and redirect oil shipments, if they can freeze bank accounts and seize sovereign assets with the stroke of a pen, then US treasuries aren't safe assets. They're hostages. So they made a decision, a calculated, systematic decision to decouple from the US financial system before the US financial system could be weaponized against them. What we're witnessing isn't a market correction. It's a controlled demolition. The mechanics are brilliant and terrifying. Instead of dumping treasuries on the open market, which would crash the price instantly and destroy their own holdings, the Chinese are using derivative structures. They're shorting treasury futures while simultaneously lending their physical bonds into the repo market. This creates a price ceiling that prevents the bonds from rallying while generating cash flow from the lending fees. But here's the genius part. Every time the Federal Reserve tries to support the bond market by buying treasuries, the Chinese short more futures. The Fed's own buying pressure becomes the liquidity that allows Beijing to exit their positions at favorable prices. The Fed is unknowingly facilitating their own abandonment. This morning, the 10-year Treasury yield spiked to levels we haven't seen since before the pandemic. The financial media is blaming it on inflation concerns or Federal Reserve policy expectations. They're lying, or they're ignorant. Take your pick. The real cause is a coordinated liquidation by the world's second-largest economy of their dollar-denominated assets. And it's accelerating. We're seeing massive block trades in the overnight sessions, billion-dollar treasury sales executed in the Asian morning hours when US institutional investors are asleep. By the time Wall Street wakes up, the damage is done. The yields have gapped higher, the bond prices have gapped lower, and the Chinese positions are gone. The ripple effects are already devastating the financial system. Regional banks that loaded up on long-term treasuries during the pandemic are watching their balance sheets implode. Their assets are declining in value while their liabilities, the deposits, remain constant. This is a recipe for bank failures, multiple bank failures, systemic bank failures. The Federal Reserve is trapped. If they raise interest rates to defend the dollar and attract foreign capital, they'll accelerate the banking crisis. If they lower rates to save the banks, they'll weaken the dollar and accelerate the treasury sell-off. If they print money to buy the treasuries that China is selling, they'll validate Beijing's thesis that the dollar is being debased to worthlessness. Every option leads to destruction. This is what financial warfare looks like. Not cyber attacks on power grids, not military invasions of trading floors, just a methodical, ruthless exploitation of the structural weaknesses that decades of deficit spending have created in the US financial system. The stock market sell-off you're seeing today isn't about earnings or economic growth. It's about liquidity. When treasury yields spike, money flows out of risk assets and into bonds. But when the bonds themselves are under attack, where does the money go? Into gold, into commodities, into anything that isn't a promise from a government that's hemorrhaging credibility. China knows something that Wall Street doesn't want to admit. The US can't afford its debt without foreign buyers. The deficit is too large. The interest payments are too high. The domestic savings rate is too low. For decades, America has relied on the kindness of strangers, particularly Chinese strangers, to fund its government and maintain its lifestyle. That kindness just ended. Beijing isn't doing this out of spite. They're doing this out of survival. They've watched what happened to Russia when their central bank reserves were frozen. They've watched what happened to Iran when their oil payments were blocked. They've watched what happened to Afghanistan when their sovereign assets were seized. They've learned the lesson. Dollar assets aren't safe assets if you're not aligned with Washington's geopolitical agenda. And Beijing has no intention of aligning with Washington on Taiwan, on trade, on technology, or on the future world order. So they're building an alternative. While they liquidate their treasury holdings, they're accumulating gold, physical gold. Tons and tons of physical gold. Not gold ETFs, not gold futures, not gold derivatives. Actual bars sitting in actual vaults that can't be frozen by executive order or seized by judicial decree. They're also accumulating strategic commodities, oil, copper, rare earth minerals, the physical resources that power industrial civilization. They're trading paper promises for hard assets. They're trading financial claims for real wealth. And they're not alone. Russia is following the same playbook. Iran is following the same playbook. Even traditional U.S. allies are starting to diversify their reserve holdings away from dollars and treasuries. The coalition that has supported American financial hegemony for 70 years is fragmenting. The velocity of this change is stunning. Just 5 years ago, central banks around the world were buying U.S. treasuries as fast as they could print them. Today, they're net sellers. The Federal Reserve has become the buyer of last resort for its own government's debt. This is not sustainable. This is not normal. This is the end stage of a monetary system that has lived beyond its natural lifespan. Wall Street is finally starting to understand the implications. The sell-off today isn't a temporary correction. It's a structural repricing. A recognition that the risk-free asset, the foundation of every financial model and every portfolio allocation strategy, isn't risk-free anymore. When treasury bonds become risk assets, everything else becomes more risky. When the global reserve currency becomes just another currency, everything priced in that currency becomes more volatile. When the world's largest debtor loses its largest creditor, the mathematics of that debt become unsustainable. The Chinese liquidation isn't just changing bond prices. It's changing the fundamental architecture of global finance. For the first time since World War II, the U.S. Treasury market is facing systematic, coordinated selling pressure from a counterparty large enough to move prices and sophisticated enough to execute the strategy without destroying their own positions. This is what controlled demolition looks like in financial markets, not a sudden collapse that destroys everyone. A methodical, calculated dismantling that allows the demolition crew to profit while the building comes down. Beijing is the demolition crew. The U.S. Treasury market is the building, and we're all standing inside wondering why the lights keep flickering. The question isn't whether this ends badly. The question is how long it takes and who survives. The Chinese have positioned themselves to profit from the collapse of the system they helped build. American institutions are positioned to be destroyed by the collapse of the system they thought they controlled. Look at what's happening in real time. The pension funds that bought 30-year treasuries at 2% are watching their portfolios disintegrate. The insurance companies that match their long-term liabilities with long-term government bonds are facing solvency crises. The regional banks that thought government debt was the safest collateral are discovering that safety is an illusion when the largest holder decides to liquidate. Meanwhile, the Chinese are recycling their treasury proceeds into strategic assets that can't be printed, can't be confiscated, and can't be devalued by central bank policy. They're buying oil fields. They're buying mining companies. They're buying farmland. They're trading financial assets for real assets. This isn't just smart investing. This is economic warfare conducted through market mechanisms. Beijing has turned the U.S. Treasury market into a weapon against itself. Every bond they sell weakens the U.S. fiscal position. Every yield spike they create makes American debt service more expensive. And the timing is surgical. They're conducting this liquidation just as the Federal Reserve is trying to reduce its own balance sheet, just as the U.S. government needs to refinance trillions of dollars in maturing debt, just as American consumers are tapped out and can't provide the domestic savings needed to replace foreign funding. The Federal Reserve officials are meeting in emergency sessions. Not the scheduled policy meetings. Emergency sessions. The kind where they don't release minutes and they don't take questions from the press. They're trying to figure out how to respond to a crisis they never prepared for. Treasury Secretary Yellen called her Chinese counterpart 3 times this week. 3 times. The calls lasted less than 10 minutes each. Beijing isn't interested in negotiations. Beijing isn't interested in compromises. Beijing is interested in results. The geopolitical implications are staggering. For 70 years, American foreign policy has been underwritten by foreign willingness to hold American debt. When you can print the world's reserve currency and other countries will accept that currency in exchange for real goods and services, you can afford a global military presence. You can afford foreign adventures. You can afford to be the world's policeman. When that willingness disappears, when the largest foreign holder of your debt becomes an active seller, your options narrow dramatically. Suddenly, you can't afford the foreign military bases. You can't afford the foreign aid packages. You can't afford the luxury of global hegemony. Beijing understands this calculation better than Washington does. They're not just attacking the US financial system. They're attacking the foundation of American global power. They're forcing a choice between fiscal sustainability and imperial ambitions. They're making it impossible to have both. The Europeans are watching this unfold with growing alarm. They hold massive amounts of US Treasuries in their central bank reserves. They're starting to ask uncomfortable questions. If China is selling, what do they know that we don't? The answer is not safe at all. The entire edifice of dollar hegemony depends on the willing participation of foreign creditors. When the largest of those creditors becomes an adversary, when they weaponize their holdings against the system, the foundation cracks. And once it starts cracking, the cracks spread. Other central banks start diversifying, other sovereign wealth funds start reducing their dollar exposure. The derivatives markets are already pricing in systemic risk. Credit default swaps on US Treasury debt are trading at levels that suggest real concern about American creditworthiness. This is the moment historians will point to, not when the empire fell, but when the empire's financial foundation was deliberately undermined by those who had helped build it. The Chinese liquidation of US Treasuries isn't just a market event, it's a geopolitical earthquake, a tectonic shift in the balance of global power. The Americans still have the largest military. They still have the most sophisticated technology. They still have the most dynamic economy. But they no longer have the automatic financing that allowed them to use those advantages without constraint. Beijing has changed the rules of the game by refusing to continue playing by the old rules. They're not trying to replace the dollar with the yuan. They're trying to replace the financial system with something that can't be weaponized by any single nation. This is the great reversal, the great rebalancing, the moment when decades of financial imbalances finally correct themselves through market forces rather than political agreements. Beijing has chosen the timing. Beijing has chosen the method. Beijing has chosen to pull the plug. And Wall Street is just now beginning to understand that when China pulls the plug, the water doesn't just drain slowly, it rushes toward the exit. It accelerates. It creates a whirlpool that sucks everything down with it. The liquidation has begun. The mathematics are inexorable. The outcome is inevitable. The only question is whether you're positioned for what comes next, or whether you're still holding paper promises from a system that just lost its most important creditor. The plug has been pulled, the water is rushing out, and there's no putting it back in.